All right, let's clear up something a lot of traders get mixed up. The difference between a market structure shift and a change in state of delivery. They might look similar on the chart, but they serve totally different roles in your analysis. Now, let me walk you through a clean example, kind of like a textbook setup. So first, market structure shift. This is your classic trend change. The moment the market flips the script, you go from bullish to bearish or bearish to bullish. Here's what it looks like. We form a swing low, liquidity gets taken, then boom, price expands and closes below that swing low. That close is what shifts the structure. It's the market telling you, hey, I'm done going that way. Now let's talk about change in state of delivery. This one's more about how price is moving, not just where it's going. It's not watching for a close below the swing. It's paying attention to displacement below the open of a previous bullish candle or a series of them. When price breaks and closes below that opening level, that is called as change in state of delivery. Now, here's the cool part. When you compare these two on the chart, you'll often notice the change in delivery comes before the structure shift, almost like the market whispers a warning before it screams it. And sometimes both happen on the same candle. So now let's pull up TradingView and look at how this plays out in real examples. Now, in front of us, we have the Euro USD chart. You can see that price has been forming series of higher highs and higher lows, clearly indicating an uptrend. At the day's open, price entered what we call the AMD phase, manipulating during the London session, and then giving us a change in state of delivery during the pre-New York session. Now, how did I know that price gave us a change in state of delivery? Well, price closed below the open of a series of green candles. I'm referring to the 15-minute time frame here. If you switch to the 1-hour time frame, it shows up as a single green candle where price also closed below its open, confirming the change in state of delivery. After that, we saw a market structure shift on the 15-minute chart, and price continued to expand lower. Now, here's something important. I wouldn't recommend beginners trade solely based on a change in state of delivery. Why? Because there's a lot happening behind the scenes when you execute a trade, and change in state of delivery is just one small piece of the puzzle. Take this chart, for example. You'll see price gave multiple changes in state of delivery. That can easily confuse a beginner, especially someone who hasn't yet learned how to build a daily bias or understand the broader market narrative. The market loves to trap traders from all sides, and without proper context, these signals can be misleading. So instead, if you're a beginner, you should focus more on market structure shifts. Wait for confirmation, then look to execute your trades. As I mentioned earlier, change in state of delivery is just one tool. It should be used alongside other important concepts like your daily bias, PD arrays, liquidity, and more. Now, if you're just starting out, stick to market structure shifts. Once you gain more experience and develop a deeper understanding of market behavior, you can start incorporating change in state of delivery into your strategy.